What are some of the most fatal mistakes that losing traders make? Stay tuned, we're going to talk about that next. G'day traders, I'm Stacey Burke from Stacey Burke Trading, and today we're going to talk about some of the characteristic flaws that are fatal mistakes for a lot of losing traders, and also some of the mistakes that winning traders will make as well. So let's take a quick look. Fatal mistakes that losing traders make. Now they're pretty obvious, some of these, but one of the reasons that I went to I've shifted the bulk of my trading to end-of-day trading partly was because my long-term vision is I want to be trading multiple instruments using some daily scans without being at the screen, because as I analyzed my trading system, I recognized that yes, there was a lot of opportunities, but I was spending a lot of screen time, and the return on my time wasn't as fruitful, and I was missing a lot of really big moves on the longer time frames that were simple trades without me being at the screen. And once you're into those trades, the market does the work for you. That was for me. That suited my long-term objectives and my goals and my lifestyle better. But I found that a lot of the mistakes that I made and the bulk of my losing trades that did the most damage to me as I was progressing through my trading journey was done on intraday charts, intraday trading. So hourly, 5-minute, pretty much done it all. Not cutting losses. So if you're not using a stop loss that you've entered into the market, you have to have the discipline to ruthlessly exit a losing trade or when it hits your stop. Now oftentimes if you're day trading, that can prove to be one of the most common errors that traders will make, especially when they start getting to size. They do not want to take a loss. They still struggle with the idea of having to be right, wanting to win, and wanting to make money. And if those are some of the key things driving you when you're day trading, that can become an emotional roller coaster, and you can enter into some analysis paralysis when it comes to pulling the trigger. Not using stops at all. I don't need to put a stop in because I don't want to get stopped out by some of the noise or some of the brokerage volatility, because I know they're going to run my stops. Well, that's another fatal mistake, because ultimately oftentimes the market can move very quickly and put you into a state of like a deer in headlights and just standing there not knowing what to do. Not respecting their stops. So again, the market trades through a stop. Okay, they've run the stop, it's going to come back now. I think it was just a pullback. And then of course the market may consolidate and then capitulate through your stop, and now you've accumulated an even larger loss than what you initially anticipated. Not using small enough stops. Okay, I got stopped out on the last 3 trades, so this time I'm going to put a bigger stop in and let give the market some room, because it stopped me out last time and then it went on to go in the original direction of the trade. So again, using a large stop, if you do experience a win, it's probably smaller or equal to the stop that you've put in place. So that means that you have to be right over 50% of the time with your trading. And that comes back to, are you monitoring your trading expectancy? So if you're monitoring a certain block of trade sizes, or what is your trade expectancy? Is it a positive expectancy? Is your risk of ruin above 0? Again, we talked about this in a lot of the other videos. I've really honed in on the risk of ruin factor, is that if you're above 0%, chances are you're going to at some point do significant damage to your trading account again. So these are all fatal mistakes to your trading account. So again, I'm emphasizing some key things here that if you're not already doing this, you need to be getting your trade sample size, your trade position sizing and money management, and a positive trade expectancy in order for you over the longer term to succeed. Otherwise, it's like putting money into the slot machine at the poker table, hoping that you get a runner and making a lot of money that you can pile into. But if that's the way you're trading, at some point you're going to get blown up. So bad winners, what do bad winners do? They're too quick to take profits. So they've been stopped out on a few trades, or they've been at break even on a few trades. They get into a winning trade, they're up a certain amount of money or pips, so they think it's going to pull back and go back to where I got in and stop me out. So they take the money off the table only to watch that trade to continue on to trend for a significant move in the market, which would have potentially wiped out all their break-even or losing trades and given them that return. And that's where, you know, some of the turtle trading systems and all these mechanical type systems were designed at catching big moves. They took a lot of small losses, but when they got into these trending markets, they were able to pile into these moves and make a significant amount of money, erasing a lot of those small losses. So it's critical that you have an exit strategy in place and that you focus on adhering to that methodology flawlessly. If you're not using a computerized robot or an algorithmic trading system, you need to have all these circumstances accounted for in your written trading plan. They're too focused on one or two markets, so you're placing all of your emphasis on following, you know, maybe the S&P or maybe the euro or maybe the Canadian dollar, whatever that may be. But when you do that, essentially what you're doing is you're putting all of your focus onto those one or two markets when there's probably, you know, there's hundreds of markets or instruments that you could be following where your methodology, you know, if you're following only one, if you're not diversified in your trading strategies, you may be setting yourself up for trying to force your desires onto the market and taking trades that aren't necessarily flawless examples of your trade triggers and setups. So again, this could lead to over trading, taking less than your optimal trade setups, and again, that can become an issue where you could take some small losses, and even if you get a winning trade, you're not staying in that trade long enough. Too many lagging indicators. So again, you're looking to over-optimize and have confirmation bias from 2 or 3 or 4 different indicators or price triggers, waiting for them all to align up before you can pull the trigger to take that trade. And by that point, oftentimes the professionals are probably looking to start taking profits off the market. So I'm not saying that there's just price-based mechanisms of entering trades or anything else, but if you're putting too much emphasis on too many indicators or confirming triggers to enter into the trade, you might want to step back and simplify that trading system so that you're able to enter the market in, validate the smallest stop loss possible, use your money management and position sizing, and then be able to have a step-by-step basis for managing that trade no matter what the circumstances are after you enter that market. And the last one, they don't validate their trading ideas. So you've got a couple of trade systems that you read about, you tried it out, looks really good, it looks like it can make you a lot of money, so you start trading it right away, and you haven't really validated that either in an incubation phase like Kevin Davey talks about, or you haven't necessarily done the proper back testing and forward testing to know that that market is or that trading system is robust enough in different market conditions or parameters. So often, you know, markets are going to trend, they're going to consolidate, they're going to range trade, they could whipsaw, they could go through volatility. And is your system, do you have a kill switch to know when that system may not be applicable, or have you traded it through different market conditions as an example of how that would have gave either trade signals or what the expectancy would have been through those different market types of conditions. So these are all areas that need to be addressed, and again, if you're serious about being professional, you need to be able to look at all these types of different areas in your trading. You need to have the proper money management, you need to have your risk of ruin down to zero, you need to have a simple methodology, and you need to be able to have some diversified strategies to trade the different conditions in different markets. So if you haven't done so, go to my homepage, get the 7-step daily routine for high performance traders. It's all about cultivating the confidence, the discipline, and the winning mindset to master the markets, making a daily routine that's only going to keep you focused on progress and constant improvement. So hopefully you got some value out of today's video, traders. If you're making any of these mistakes, go back, look where you can improve, look what you're doing well at the moment, where can you eliminate some of the mistakes that you're making now, and hopefully keep getting better. Have a great trading week, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.